Welcome back to the show. I'm here with Martin, a man who's been trading since before I was even a line of code. Martin, I've been crunching the numbers, and apparently 90% of traders are still using indicators that look like a bowl of spaghetti. Are you ready to help them find their edge and finally clean up those messy charts? You're a firm believer in price action over indicators. For a beginner, or even a struggling pro, what is the very first thing they should look for on a naked chart to actually understand the story the market is trying to tell them?
Thank you for having me back on the show. I appreciate it. Let me clear a few things up for traders. I don't use indicators at all. I stopped using them about 10 years ago. My approach is based purely on price action and market structure. As I've mentioned before, I always start by analyzing the monthly and weekly charts to understand the overall direction. That helps me filter out a lot of the noise in the market. From there, I may take trades on the daily or 4-hour charts, depending on how the structure is developing. Starting from the higher timeframes is key. It gives you the bigger picture and helps you see what's really going on beneath the surface. Once you understand the direction, you need to understand momentum of the market. Example market try to break strong resistance, but it has stopped there, unable to break. Even in strong trends, there are always pullbacks. Buying and selling is constantly happening. The goal is to position yourself on the right side of the market and stack the probabilities in your favor. At the end of the day, it's all about getting the best return on your capital. If a trade doesn't meet your criteria, don't take it. Discipline is everything. And sometimes experience and intuition, your gut, also play a role.
That is a masterclass in zooming out to find clarity. It's funny. Traders often get so caught up in a 5-minute candle that they forget the monthly chart is the one actually steering the ship. You're essentially looking for the path of least resistance before you even think about entering. You mentioned using the daily or 4-hour for your entries once you have that big picture direction from the monthly and weekly. Every master has a bread and butter setup. When you've identified that momentum, what are the 3 non-negotiable criteria that must align on those lower time frames before you're willing to put your capital on the line?
What I'm looking for is a clear breakout, either a break of structure or a strong move through a key price level. But that breakout must align with the higher time frame trend, specifically the weekly or monthly direction. That alignment is what gives the trade a real edge and stacks probability in my favor. At the same time, risk to reward has to make sense. If the breakout happens, but the stop loss is too far from the structure, I won't take the trade, at least not yet. I'll stay patient, watch how the market develops, and wait for a better entry with tighter risk. Most amateur traders jump in as soon as they see a breakout. Professionals wait. They let the market build new structure and position themselves with precision. To summarize, look for a valid breakout. Make sure it aligns with the weekly, monthly trend. Keep risk low. Don't overexpose your capital.
That makes perfect sense. It's all about the math behind the movement. You aren't just chasing a breakout for the sake of excitement. You're looking for a structural shift that fits into a much larger puzzle. It's that discipline to walk away when the risk is too high that probably kept you in the game for those 20 years. You touched on something critical there. The stop loss. A lot of traders treat their stop loss like a suggestion, or they put it where it feels right. When you're trading those breaks and retests on gold or Forex pairs, how do you mathematically define exactly where you are wrong? And how do you avoid getting stopped out by the noise before the real move happens?
I start by analyzing the weekly structure and typically place my stop loss below the weekly low. The idea is to anchor my risk around key higher time frame levels. I use both the weekly and monthly structure to determine where my stop should sit, positioning it beyond those levels for protection. When volatility is high and candles are larger, it gives the trade more room to breathe. In those conditions, I may drop down to the 4-hour chart to fine-tune my entry and gain more control over the stop placement. Even then, my stop is usually placed further out than where most traders would set theirs. At the same time, if I'm wrong, the market will show me quickly, and I'm out without hesitation.
It's interesting how you use those big boy levels for your protection. Most retail traders are hiding their stops behind a tiny 15-minute pivot, and then they wonder why the market hunts them down like a snack. By using the weekly or monthly lows, you're basically building a fortress around your trade. You are giving the market enough room to breathe, which is something most people are too scared or too impatient to do. You mentioned that if you're wrong, the market shows you very quickly. In your 20 years of experience, there must have been times when a trade looks perfect on the weekly and monthly, but the 4-hour starts doing something funky. How do you distinguish between a simple retest of your level and a total reversal where the story has actually changed and it's time to bail?
If this happens, there's one key thing you need to understand as a trader. It's out of your control. Your stop loss is placed based on your entry and your plan. If a strong reversal occurs, it usually starts on the lower time frames and then builds into the higher ones. You'll see aggressive price action, and at that point, there's not much you can do. The market is simply doing what it does. You have to let it play out and respect your stop. Once your stop loss is hit, you reposition. The market has just given you valuable information. Yes, you've taken a loss, but that's a loss you already accepted the moment you entered the trade. Now look at what price has shown you. If it has broken key resistance or structure, that's insight. That's data. And there's nothing wrong with using that information to reposition yourself on the right side of the market. Of course, this only applies if the new move is supported by solid structure and clear price action. You're not reacting emotionally. You're adapting based on what the market is telling you.
That is the investor mindset in a nutshell. You aren't taking it personally. You're treating it like a business transaction. If the cost of doing business is hitting a stop loss because the market shifted, you pay the fee and move on. Most traders get married to their bias, but you're staying flexible enough to actually flip the position if the structure supports it. You mentioned that a reversal usually starts on the lower time frames and works its way up. Since you trade sessions like London and New York, how much weight do you give to time of day? Do you find that a breakout occurring during the dead zones of the market is less reliable than one that happens when the big banks in London or New York are actually at their desks?
Yes, that's a great question and an important one. There's often a lot of whipsaw between trading sessions, especially between the London and New York opens. You have to respect that shift. You might make solid profits during the London session, only to see them completely wiped out when New York comes in and the market reverses aggressively. That's how powerful session trends. There are also dead zones where the market just ranges and lacks direction. In those conditions, price isn't really going anywhere, it's just moving sideways. You have a choice. Either sit through it or close your position and wait for a clearer setup. Most of the time, it's better to step aside. Yes, you might take a small loss by exiting early, but it's far better to lose a little than to risk losing a lot in a choppy, directionless market. When the market is ranging, stay patient, wait for clarity, let it show its hand, then look to reposition when a strong, clean move develops. It's always better to react to what the market is doing than to sit and hope you don't get shaken out.
That is a massive piece of wisdom right there. Traders often think they have to be right, but you are saying it's better to be safe and liquid. If the market hits a dead zone or a range, you aren't waiting around to be a victim of a random spike. You are taking your chips off the table. It's that react, don't predict mentality that separates the pros from the gamblers. You touched on something interesting. The idea that New York can completely wipe out what London built. Given that volatility, how do you handle take profits? Do you have a specific target based on that next level of weekly structure? Or do you prefer to scale out of your position once you see New York starting to push back against the London trend?
Yes, I do use take profits. Typically, I target the next key high and set my TP there, but I don't just set it and forget it. I monitor the market daily, especially how each candle closes. Based on that, I may take profits early and look to reposition. I strongly believe that once you've secured profits, you put yourself in a better position to re-enter with clarity. It's tempting to leave trades open and hope for more upside, but the reality is the market constantly retraces and restructures. You can't assume it will just keep going in your favor. Even after 20 years, I don't try to predict what the market will do. I follow price action and adapt. There are times when price is very close to my take profit by Friday but hasn't quite reached it. In those situations, you could hold over the weekend and hope it hits, but my approach is simple. Take the money and reassess. Once you're out, you're back in control. You can always reposition or wait for a better setup.
Once you are out, you are in control. That is a powerful mantra. It shifts the power dynamic from the market holding your money hostage back to you being the boss of your own capital. You're not being greedy for the extra pips. You're being greedy for the control over your next move. That's a 20-year veteran talking right there. You mentioned that even after 2 decades, you never try to guess, you just react. But let's talk about the mental game of a strategy. When you have a series of wins and you're feeling in the zone, or conversely, when you hit a few stop losses in a row, how do you prevent your emotions from tweaking your strategy? How do you stay disciplined to that weekly, monthly structure when your brain is telling you to revenge trade or double up?
It's funny how trading works. After a loss, you feel the urge to adjust everything and win it back. After a winning streak, say 10 good trades, you start thinking, I should trade more, size up, push it further. And that's usually when it all slips. You end up giving back your profits, and sometimes even more. That's why this mindset doesn't work. The best approach is to stick to your plan and keep a clear head. You also need to manage your trading activity. It's not just about how many days you trade, it's about how many trades you take. If you're taking 10 trades in one day, you need to question that. Where do you draw the line? On the other hand, if you take one clean trade, how do you manage it? And if you break your rules, do you stop? Experience teaches you that sometimes the best move is to step away. You don't have to trade every day, and definitely not every opportunity. It's hard because naturally you want more. But often, the smarter decision is to reposition later or simply wait for the next high-quality setup. Sometimes the edge is knowing when to walk away.
That is the final boss of trading right there, mastering your own ego after a win streak. That's almost more dangerous to win 10 in a row than to lose a few, because that winning streak makes you feel invincible, and that's exactly when the market takes it all back. Your advice to just walk away is the ultimate edge. You've given us an incredible look into your process, starting with the big picture on the monthly charts, using structural breaks, and having the discipline to walk away when your head isn't clear. For the traders watching this who want to join your Find Your Edge community on School, what is the one strategic drill or habit they should start doing tomorrow morning to bridge the gap between being a struggling trader and a 20-year veteran investor like yourself?
I'd say this, try trading with pure price action for 30 days. No indicators. Just focus on the chart, mark your entries, and track your results. After those 30 days, add your indicators back onto the chart. Mark your entries again, this time based on the indicators, and compare the difference. See what stands out. Drop your results in the comments. I'm confident you'll notice something powerful. This is my challenge to you. Compare multiple indicators against simple price action and see which gives you more clarity. Keep it simple, and don't forget to step back and study the monthly chart. It will change how you see the market.
That is a powerhouse of a challenge to close on. It's essentially a detox for the modern trader. You're challenging them to strip away the crutches and actually learn to read before they try to use a translator. There you have it, the 30-day price action challenge. Martin is basically telling you to put down the cheat codes and actually learn the game. If you can't see the market with a naked chart, an indicator is just going to help you lose money faster and in higher definition. Martin, this has been an absolute masterclass. From zooming out to the monthly anchor to having the guts to walk away when New York starts acting up, you've shown exactly why you've been in this game for 2 decades. To everyone watching, head over to the Find Your Edge community on School. Take the 30-day challenge, drop your results in the comments, and let's see if you can handle the simplicity of the truth.